Hey guys, welcome to the video. Today we're going to be talking about Zoom. Zoom is dipping right now, and this is a video about what I am doing about that. So let's get into it really quick. If we take a look at the chart for Zoom here, you can see that it went down about 15, 16%-ish. Before it was at what was it? $345-ish, and now it is at roughly 290-ish. So why did it go down? Why did it like tank so much? Well, for that we got to take a look at the investor presentation that they released recently, and also the 10Q that they released. So let's take a look at a slide from the presentation that they did. This is a presentation that they did on August, I think it was August 30th, and you can find this on the investor relations page of the Zoom website. So yeah. So why did it go down? Well, for that, we got to take a look at revenue and also customers. So revenue growth, as time has been increasing, you can see that it is going up. So revenue numbers continue to go up, which is good. The main thing is that the year-on-year growth, so like the rate at which the numbers go up, like the speed of the increase, that speed is going down. So for example, here you can see Q2 FY 2021, it increased 355% year over year. So that's compared to the prior year. And also for Q3 fiscal year 2021, it increased by 367%. So these numbers were pretty high, but now for the latest numbers that they released, that growth has decelerated. It has gone down. It's still growing, it's just not going as fast. So you can see it's at 54%. So the company is still good in my opinion. The main reason why a lot of people are selling and why it's gone down is just that they're worried because it's not growing as fast. But for me, I'm not worried at all. I'm still holding all of my shares, and I think that the company will continue to grow and do great things in the future. And yeah, that was just revenue. Also for the customers is another reason why it went down. Let me get into that really quick. So customers here, you can see they split it up into customers that have more than 10 employees, and also for the customers that have made $100,000 in revenue for the trailing 12 months. Same situation here. You can see back in Q2 and Q3 fiscal year 2021, the rate of increase for the year-over-year growth rate was at like 458%, 485%. For the one with more than 10 employees, and down here for the 100K trailing 12-month revenue, it was at 112%, 136%. If you compare that to now, here you can see that for customers with more than 10 employees, the growth has decreased. And here for customers with 110K for the trailing 12 months, that has decreased a little bit as well compared to Q1 fiscal year 2022. So yeah, for 10 employees and up, year-on-year growth right now it's at 36%, but compare that to last quarter, it was at 87%. For the other one with the 100K and 12 trailing 12-month revenue, right now it's at 131% increase, whereas last quarter it was up 160% year over year. So yeah, but the good news is that the balance sheet and the what do you call that? The income statement. Those have some pretty solid numbers. So let's take a look at that really quick. This is the statement of operations, or the income statement. Here you can see revenue. Revenue, it has increased over time. Here you can see 3 months ended July 31st. Here we have July 31st, 2020 compared to now 2021. Here, this number here, it is less than the current one. So it's increasing over time. So that's good. Same for the 6 months ended July 31st. Here you can see for 2020 compared to 2021, the number in the past is lower than the current one. So numbers are going up. That's good. It went up from, here you can see 663,000 to about 1 million for the 3 months ended. And for the 6 months ended, it went up from 991,000 to about 1.9 million. And also what I like is that the Net income. Net income has also increased. Here you can see same situation. The ones in the past for 3 months, it is lower than the current one, so it's going up over time. Same for the 6 months ended. Same situation, it's going up over time as well. So, for example, let's see, take a look at the numbers exactly. It was at 185K for 2020, and now it's at 317K. And for us, the 6 months ended, it was at 213K, and now it's at 544K. So that's good. So that was the income statement, and let's take a look at the balance sheet. The balance sheet, one thing that you could say is a negative here is that the cash and cash equivalents, did go down slightly. Before it was at 2.2 million here, and this is all in thousands actually. I'm just going by the number that's actually written on here, 2.2 million, and now it's at 1.9 million for July 31st, 2021. Uh, but if you compare cash and cash equivalents to total current liabilities, which is kind of like the bills that they have to pay and they have to pay it soon, the cash is higher than that. So for example, here we have 1.9 million in cash, but current liabilities, that's at 1.6 million. So that's a really good plus for the company's balance sheet. Same thing for the past, they had that in the past as well. 2.2 million in current assets for the cash and cash equivalents, and the total current liabilities that was at 1.2 million. And also another plus is that the total assets are greater than the total liabilities. So yeah, total assets for the latest number, it's about 6.5 million. Total liabilities, it's at 1.8 million. So that's also good. Yeah, that's it for the balance sheets. And let's go back to the presentation really quick. I wanted to show you this chart. It's a pretty cool chart that I saw. Right. Here, this. Revenue growth. So, yeah, for revenue, you can see that over time the revenue is increasing. It's still going up. The only thing is it's not going up as fast. So, for those of you who want to buy on the dip, if you don't have a initial investment in Zoom and you want to buy things on a dip, like when it just went down a lot, and you think it's a really good deal, I would say that this opportunity right now is a good time to buy on the dip. Why? Because the price went down, but the financial statement still looks solid and the company still looks like it's in a really good position. Why? Because they're still constantly innovating. They're like a company that can have multiple features. They're not just stuck on one thing. So, for example, they just released Zoom Phone earlier this year, and they also released Zoom Events. So they're constantly innovating, and also their CEO, I think I think he had like a 95% positive rating on Glassdoor review, so his employees really like him. That's also a plus as well. So yeah, for me myself, I have a lot of Zoom shares already, so I'm not adding to the position. I'm just holding it. But if I did have like a smaller position in Zoom, like it was a smaller percentage of my portfolio, this is a time where I would add. It's just like I already have a decent amount that I don't want to add any more to it. I'd rather add to some of my smaller positions that I think would do better in the future. So yeah, just to sum up, if you want to buy it on the dip, this would be a good time. If you already have a lot of Zoom shares and you're wondering if you should sell, if you should buy more, if you should hold, I would say if you already have the shares and it's a large amount of in your portfolio, just hold it all. If you have have Zoom shares and it's like a small percentage of your portfolio, like maybe I don't know, less than 5%, and you want to add more, then I mean it's a good time to add more. I wouldn't do more than 5% for the initial, let me close that, for the initial purchase. So yeah. Anyway, that's it for today's video, and I'll see you guys in the next one. Bye.